So let's try and knock this out. Chapter 15, we're going to talk about corporations, and there are a couple different types of corporations that we talk about. Mainly we're talking about C corporations, but we'll talk a little bit about S corporations toward the end. The C corporations are the corporations that we're all familiar with. Like if it has INC at the end, generally speaking, it's probably a C corporation. All the big companies that we kind of think of when we think of corporations, that's what we're talking about. S corporations, if you recall, I talked a little bit about how there's sort of this hybrid between a partnership and a C corporation. S corporations tend to be more small companies, mom and pop types of stores, that sort of thing. C corporations tend to be a little bit bigger, although they don't have to be. But we're going to talk about how corporations are taxed. Like I said, mostly C corporations. That last part is about the S corporations. Different rules. I mean, we still have the requirements for recognizing income and what is income and what is an expense, and that ordinary, necessary, and reasonable still has to be satisfied. But there are some different rules for corporations. Some of them are more favorable than for individuals, and some of them are less favorable than for individuals. But we're going to talk a little bit about how corporations are formed, what needs to be done in order to form a corporation. We're going to talk about basis. Again, the basis for corporations is not nearly as complex as basis for partnerships. So, that's great. But we will talk a little bit about basis and how, an individual's basis in a corporation when it's formed, and how individuals obtain additional basis in that corporation. We'll talk about there's a tax formula for figuring out taxable income and tax liability for corporations. Now, one of the nice things about corporations is, so there's no AGI with corporations. There's no adjusted gross income. And as you recall, with individuals, adjusted gross income is really important because it affects other deductions and other credits and things like that, different places on the tax return. We don't have AGI with corporations. And another nice thing about corporations is calculating the tax liability is actually quite easy. Once you arrive at taxable income, it's just multiplied by 21%. There's one tax rate for C corporations, and that tax rate is 21%. So that's really nice. We don't have that progressive tax structure where we've got marginal tax rates and average tax rates. We just have one tax rate for C corporations. We're also going to talk about different tax rules for transactions with shareholders. So things like when the corporation pays dividends or pays something out of itself, gives shareholders something in return for their investment, what the tax rules are for reporting that. We're also going to talk, this is probably the area that causes the most consternation in this chapter, is the Schedule L is not really a big deal. That's just a balance sheet. But the Schedule M1 and M3, that is that book to tax adjustment that has to happen. We have it on the partnership return as well. This is where we start with our book income or loss, and we make all these adjustments to that to arrive at our tax income or loss. And there are lots of intricacies to that. In fact, you'll see that I posted some videos where I go through. You probably want to watch them. When we get to that, we may even take a look at them here in class. These videos where I go through a problem for solving an M1, and it's in several steps. It's a story in multiple parts. But that's probably the area that students really struggle with in this chapter, is figuring that out, because it kind of requires you to step back and really think some things through. But we're going to go through that. I don't even remember what the other corporate issues is. And then we'll finish up by talking about those S corporations. So that's what we're doing in this last chapter here.